No doc underwriting secrets. What is an underwriter really trying to do? Before we talk about denials, let's understand the person making the decisions. Many people think an underwriter is sitting behind a desk trying to find reasons to ruin your day. That's not true. An underwriter has one job: determine the likelihood that this loan gets paid back. That's it. They're not asking, is this person nice? They're asking, if something goes wrong, what are the chances we'll lose money? Everything they review points back to one question: how risky is this loan? Every document, every appraisal, every bank statement, every lease, every reserve account, it's all about measuring risk. The lower the risk, the easier the approval. One of the biggest myths on YouTube is this: DSCR loans don't require documentation. That's completely false. You may not need tax returns, but you'll still provide plenty of documentation. For example, government issued ID, credit report, purchase contract, appraisal, insurance, title work, asset statements, lease agreements, entity documents if purchasing in an LLC, operating agreements, property information, rent schedules on multifamily properties, reserve verification in reality. A DSCR loan simply shifts the focus. Instead of proving your income, you're proving the property's strength. That's a huge difference. This is the number one reason the property's income simply isn't enough. Denial number one: property doesn't cash flow. This is the number one reason the property's income simply isn't enough. Let's look at an example. Monthly market rent of $2,700. Monthly mortgage payment, principal, interest, taxes, and insurance. Total is $3,150. Now let's calculate the ratio. 2,700 divided by 3,150 equals 0.86. Many investors think, I'll just cover the difference. The lender doesn't care. Remember, the property has to support itself. Some lenders allow ratios below 1%. Others don't. Some require 1.00, 1.05, 1.10, 1.15. Every lender is different. That's why choosing the right lender matters just as much as choosing the right property. Let's give an example. We have a green property. The rent is $3,600. The payment is $3,100. Approved. Then we have a red property. The rent is $2,700. Payment is $3,300. Possible denial. Denial number two: the appraisal comes in low. This surprises a lot of investors. You negotiate a great deal. You're excited. Inspection is complete. Everything looks perfect. Then the appraisal comes back. Instead of $500,000, it's worth $465,000. Now your loan to value changes. Maybe your down payment suddenly increases by $25,000. Maybe your reserves aren't enough anymore. Maybe the DSCR ratio changes. One appraisal can completely change the file. And here's another thing many investors don't realize: the appraisal isn't just determining value. It also determines market rent. If the appraiser believes your property rents for less than expected, your DSCR calculation can fall below the lender's minimum requirements. Even if you have a signed lease at a higher amount, lenders may have specific guidelines about which rental figure they'll use depending on occupancy and the appraisal. That's why buying based on optimistic rent projections can be dangerous. Denial number three: not enough reserves. Let's talk about reserves. This is where experienced investors separate themselves from beginners. Many lenders require 6 to 12 months of reserves. Some portfolio lenders require even more. So what are reserves? Money left over after closing, not before. After. Let's say you're buying a property requiring a down payment of $150,000, closing costs of $15,000. You have exactly $165,000. Problem is, you have nothing left. The lender says, where are your reserves? You need money available in case the tenant leaves, the HVAC dies, the roof leaks, property taxes increase, unexpected repairs happen. Real estate investing isn't just about buying the property. It's about surviving surprises. Underwriters know that. Denial number four: poor credit isn't the only credit problem. Everyone focuses on credit scores, but underwriters reach more deeper. A 740 score isn't automatically better than a 700. They're looking for patterns. Questions like, have you had late mortgage payments, recent bankruptcies, recent foreclosures, large unexplained collections, too many new credit inquiries, recently maxed out credit cards. A 760 score with a mortgage late payment last month may concern an underwriter more than a clean 700 score. Consistency matters. Denial number 5, liquidity problems. Here's another mistake. The borrower technically has plenty of money, but it's trapped. Maybe it's all in retirement accounts. Maybe it's tied up in another investment. Maybe it's in cryptocurrency the lender won't count. Maybe it's in a business account with restrictions. Lenders generally want accessible, verifiable assets, not just wealth on paper. If all your money isn't accessible, you may have a problem. Denial number 6, the property type. Not every investment property is created equal. Some lenders love single-family homes, duplexes, triplexes, fourplexes. Others become more conservative when financing vacation rentals, mixed-use properties, condotels, non-warrantable condos, unique luxury homes, log cabins, large acreage, rural properties, properties with unusual layouts. Why, you ask? Because if they ever had to foreclose, who buys them? The smaller the buyer pool, the greater the lending risk. Denial number 7, short-term rental income. Airbnb investors, pay attention. Many investors assume my Airbnb makes $8,000 a month. Perfect. Not always. Some lenders use historical Airbnb income. Others use AirDNA reports. Others use appraiser estimates. Some don't allow projected short-term rental income at all. The lender's calculation may be significantly lower than what you're actually earning. Know your lender's guidelines before you make an offer. Denial number 8, too many finance properties. Different lenders have different comfort levels. Some specialize in investors with 20, 30, 50, or even 100 properties. Others don't. If you're growing a large portfolio, you need a lender whose underwriting guidelines match your investment strategy. Otherwise, a perfectly good borrower can receive a perfectly avoidable denial. Denial number 9, title problems. This one catches investors off guard. Maybe there's an old lien, an ownership issue, a judgment, an estate problem, an unresolved divorce, a boundary dispute. None of these things have anything to do with your income, yet every one of them can delay or even stop a closing. That's why working with an experienced title company is just as important as working with an experienced lender. Denial number 10, the borrower changed something before closing. This is the easiest denial to avoid. Please don't do these things while you're buying a property. Don't finance a new car. Don't open new credit cards. Don't move large amounts of money without documentation. Don't change LLC structures without discussing it with your lender. Don't wire your closing funds from an account the lender has never seen. Communicate first. One phone call can save weeks of delays. How to get approved every time. While nothing is guaranteed, you can dramatically improve your chances by following these steps. Step number 1, know your credit before applying. Step number 2, have your down payment and reserves seasoned and documented. Step number 3, run realistic rent numbers, not optimistic ones. Step number 4, work with an investor-focused mortgage professional. Step number 5, understand your exit strategy. Step number 6, choose the right lender for your specific property type. Step number 7, don't make financial changes during the loan process. Step number 8, ask questions before writing an offer, not after you've gone under contract. The biggest secret most loan officers never tell you, not all DSCR lenders are the same. One lender may decline your deal. Another lender may approve it the same day. Why, you ask? Because every lender has different DSCR requirements. Credit score requirements, reserve requirements, loan-to-value limits, property eligibility rules, short-term rental guidelines, maximum loan amounts, experience requirements, pricing adjustments. As a mortgage advisor, one of the most valuable things I do isn't just find a loan. It's matching the borrower with the lender whose guidelines best fits the deal. That's why shopping for the lowest interest rate without understanding the underwriting can actually cost you more time, money, and missed opportunities. If you remember only one thing from today's video, remember this. A DSCR loan is not an easy loan. It's a different loan. You're replacing personal income underwriting with investing underwriting. The lender wants to know, does the property make sense? Does the borrower have the financial strength to handle unexpected issues? Does this investment fit within their lending guidelines? If you prepare for those questions before you apply, you'll dramatically increase your odds of a smooth approval. If this video helped you understand why investors get denied for DSCR loans, hit the like button and subscribe. Every week, I break down mortgages, underwriting, real estate investing, and financing strategies in plain English so you can make smarter decisions and avoid costly mistakes. If you're considering purchasing your next investment property, refinancing your portfolio, or you're not sure if your deal qualifies for a DSCR loan, reach out to me. My team works with multiple DSCR lenders nationwide, and because every lender has different guidelines, we can often find a solution that fits your situation instead of forcing your deal into the wrong program. And before you go, leave a comment below. What's your biggest question about DSCR loans, investment financing, or building a rental portfolio? I read every comment, and your question could become my next video. Thanks for watching, and I'll see you in the next one.